Okay, welcome back to the tutorial of the cost volume profit analysis content that we have in this week. We have one task that we deal with in this tutorial, which is the hotel group task, which is a bit more demanding, as said already in the lecture. So a hotel group is actually about a hotel, as the name says, and they have presented you with certain financial data. So the hotel group prepares financial statements on a quarterly basis. So you see the different quarters of the year. And the senior management is reviewing the performance of one hotel and making plans for the next year. So they take this as a basis for deciding further. The managers have in front of them the results of this particular year based on some actual results and some forecasts to the end of this year. So you can actually see here the data of sales revenue, profit and loss. And then you have some more information. The total estimated number of visitors, so guests that stay per night, one night, for this year is 50,000. The results follow a regular pattern. There are no unexpected cost fluctuations, only just, of course, seasonalities are in there. At Christmas, there are probably more people, or at, let's say, New Year's or in holiday time, more people staying at the hotel. But they say all these things are actually in the revenues and profits already given, so there are no other fluctuations we have to take into consideration. For next year, management anticipates an increase in unit variable cost of 10%, and profit target for the hotel is 1 million. So now they have 800,000 and they want to get to 1 million, and these things will be incorporated into the plans of the hotel. And now what we are expected to do is, first of all, calculate the total variable and total fixed cost for the hotel of this particular year. Show the annual results for this year in totals, showing the total variable cost and also total fixed costs. And also what they want us to do is show the revenue and cost per visitor. So breaking it down to the single guest nights, basically. And then in part B, there are some variations of the break-even analysis and target profit analysis that we dealt with before. If there's no increase in visitors for the next year, what will be the required revenue rate per guest or per hotel visitor to meet the 1 million profit target? And number two, if the required revenue rate per visitor is not raised above this year, so if it stays the same, how many visitors are required to meet the profit target? And this is what we now deal with together. And you can actually see here, we have the sales revenue and the profit and loss. And what we actually know, also from looking at the income statement, is that, let's draw the income statement here. Income statement starts with sales revenue. And then, we have cost of goods sold, we have all the other expenses. And this leads us to a profit or loss. And as said before, of course, there are different kinds of profits and losses. We can calculate the net profit, earnings before interest and tax, earnings, whatever. So you know there are different ones. But just in general, this probably is the final profit, net profit that they talk about here. So we know this formula, basically. And if we know this formula, we can actually work with it. Because we know sales revenue are given, profits are given, but expenses are not given. And so the difference between the revenue and the profit and loss must somehow be the expenses. So basically, this plus expenses gives this. And this is what we can make use of now. So here I will just have another column of expenses, because then we can actually try to work further with this, because now it's difficult for us to solve part A. But we'll start with this now. So we have sales revenue, we have profit and loss, and I'll just add another column, which is the total cost. So we know for quarter one, the total costs are 680, because basically 400 sales revenue leading to 280 in loss is 680. So first quarter is 680. Then in the second quarter, we see that the difference here actually is 840. Number three, quarter three is 1,600, and this is 680. so it's 920. And number 4, we have 840, so it's 670. So now we can make use of the total cost that we calculated. Because we know, let's say, the sales revenue from, let's take just 1 quarter. Because they said there are also no other fluctuations, so we can basically also expect that the fixed cost must be the same for all the quarters, because they say there are no other fluctuations that they have. So they don't need to buy another hotel or to buy other facilities or rent other facilities. So otherwise it would say that there is a step in fixed cost. But we know quarter 1 we have 400 to 1,200, which is the increase in revenue. So we know we have plus 800 in revenues. And at the same time, we know from quarter 1 to quarter 2, we have an increase of 160 in terms of costs. So what we can actually say is, whenever our sales revenue increases by 800, like seen in the first quarter, our costs go up by 160. So now we can make use of that and put that into perspective. So we say basically 160, which are the additional costs, divided by 800 gives us 20%. So if you express that in percent, otherwise it's just 0.2. And with this we can now work further, because we can actually say 20% of our sales revenue are our variable costs. That basically is what it means, because we said now variable costs over sales revenue. So this is the increase in variable cost, and this is the increase in sales revenue. Whenever it goes up by 800, the sales revenue, our variable costs can also go up by 160. So this is 20% of sales revenue. This now what we can use to calculate further. And you can do that. You can try that with all the periods, and with all the periods it's going to be the same. You also will get to 20% in all the other quarters. Just trust me on that. I mean, you can also calculate it for yourself. But since they say there are no unusual fluctuations, the percentage of variable cost also will be 20% in the other quarters. And so the total equation with the total fixed cost and variable cost will always work out for all the quarters that we have. So now how can we determine the variable cost? Well, we know total cost, like we have here, equals fixed cost plus the variable cost. And of course, now we look at the total cost, so it's the total fixed cost and the total variable cost. So we don't calculate the break-even point at this moment, so we don't have to look at the variable cost per unit, but we now look here at the total cost. So of course we also need the total variable cost for that. So total costs are, let's take the first quarter, 680. We don't have the fixed cost, so that's our variable. I just call it X. And variable cost, we said before, it's 20% of the sales revenue. We know sales revenue has been 400 in the first period. So 400 multiplied with 20%. So this gives us 680 equals to X plus 80. And now we simply have to get rid of the 80. Just put it to the other side. So we know 600 equals X. And therefore our fixed costs for the first quarter are 600 pounds. Or I think 600,000, because of course there are 3 zeros also attached to it. And that's for the first quarter, and as they say there are no fluctuations, they don't rent another facility, another hotel, so fixed costs stay the same for all of the quarters. So we have 600 per quarter. So now we can actually make use of the things we just calculated here. And on the board, on the slides, I just put everything together, to just put everything into a table. So here we have the sales revenue, we have the variable cost, leading to the profit in the end. And now our task is to fill this table. Well, we know that sales revenue, and this is also given to us in the initial overview, is 4 million. So with the 3 zeros, of course, here it's only 4,000, but 4 million is the total sales revenue, which we have given. And if we put that to a per guest basis, it's actually basically 4 million divided by 50,000, giving us 80 pounds in revenue per guest. So the variable cost we set is 20% of sales revenue. So 20% of this gives us 800, of course minus, so in brackets. Putting that to a per guest basis is simply 800 divided by, or 800,000 divided by 50,000, so 16 per guest. Then you learn what contribution is. It's simply the difference between sales revenue and variable cost. So this is 3.2 million, and per guest, this is 64. And now, this is what we just calculated before, the fixed cost. So fixed cost per quarter times 4, because we have 4 quarters. So this is 600,000 multiplied with 4, giving us 2.4 million. Per guest, this is 48. And now, profit is basically simply contribution minus the fixed cost, leading to a profit of 800,000. And this is what we already had also in the table before, so in the initial table. And also, per guest, this is 16. And now with this information, we can actually calculate further and look at the target profit calculations we are now supposed to do. So let's now go to the part B of the task, where we really start using the break-even or the target profit formula more especially for solving the task. So they say if there is no increase in visitors for the next year, what will be the required revenue per hotel visitor to meet the profit target? So let's just write down some of the values. In the text, we see the visitors are expected to be 50,000, and they say, well, if this doesn't change, then what happens with the other variables? So this is the amount of visitors. To meet the profit target is 1 million. 1 million. And of course, for the target profit formula, now we also need other things, like the fixed costs. We know the fixed costs, like we saw in the other table that we just drew up. And I can just go to that again. The fixed costs are 2.4 million. And the variable cost, as you can see here, variable costs are 16 per guest. However, if you go back to the text now, the text told us it's expected that there is an increase of variable cost of 10%. So basically, this is plus 10%. So this is 17.6 pounds. And now also we need the sales revenue. So this was also per guest. And the sales revenue also per guest. And this is, like the text says, not given. They ask for what the required revenue rate per guest or hotel visitor is going to be. That's why this is our question mark that we have to solve by now putting everything into the formula. So target profit was quantity equal to the fixed cost, so 2.4 million, plus the profit target, which was 1 million, divided by the sales revenue per unit, which is not given, so I just call it X, because this is our variable that we want to find out, minus the variable cost, which is 17.6 pounds. And now the only task that we have is to solve this. And of course, we also know how much the quantity is going to be, because that's the amount of visitors. So that's simply the 50,000 visitors that we have. And now we have to restructure it in a way that this X is standing alone. And so what we can do is simply multiply with the whole denominator, multiply with this part here. So then we have 50,000 multiplied with X minus 17.6 pounds. And this is equal to 3.4 million, because we put it together. So then this is the amount of fixed cost plus the profit gives us 3.4 million. So now what do we do to get further? We simply divide by 50,000. So then we have x minus 17.6 pounds equal to 3.4 million divided by 50,000 guests. And then the final thing we have to do is to add the 17.6, because then we bring it to the other side. So then it's 3.4 million divided by 50,000 plus the 17.6 pounds that we had before on the other side. And this gives our x. So now, please put that in your calculator and find out what the x is going to be. So if you solve this equation now, we get to actually 85.6 pounds. This is now the amount that customers have to pay for the hotel in order for the hotel to reach its profit target of 1 million pounds. So with this, we solve part 1 of the B task. So this all was task B. And now, well, there's a different scenario. If the required revenue rate per visitor is not raised above this year's level, how many visitors will be required to meet the profit target? And now we actually have to look at different things here. Well, the visitors are not known because they actually want to find this out. So what is the amount of visitors if it's not raised? So basically this is now our question mark. Profit stays the same, fixed costs stay the same, variable costs stay the same, but they say they want to keep the required revenue rate per guest equal as it was before. So it's not raised above this year's level. And if we go to the table we had, we actually can see that the sales revenue per guest is 80 pounds. So this is simply what we have to use, 80 pounds. And now we can put it all into the formula here. So just get rid of this lower part, but the upper part we can still use for calculating our new values. So basically, the 50,000 goes away because that's what we're searching for. That's our x now. And I'll also get rid of this to make it clearer. We have 80 pounds, which is the sales revenue per guest, minus 17.6 pounds, which is the variable cost. And this is very easy because it's simply the same layout as we had in the lecture when we dealt with the target profit formula. So we simply have to now calculate this. So this is your task. Please calculate the amount of visitors that have to visit a hotel if the required revenue rate is still 80 and the profit target and everything else also stays the same. So if you solve this equation, we get to 54,487.18. And like we had also in the other task, you can't have 0.18 visitor because you can't cut them in half or give them half a bed or whatever. So then our quantity would be 54,488 because actually, of course, we need full customers and not 0.218 customers. And that's actually the way that we solve this task. In this case, it was very easy because we simply had to plug in all the values. In part B1, we had to restructure the formula a little bit. So I hope that this is clear for you. Have a good day and see you next week again.